Okay, hi everybody. I will talk about what is the corporate bond and how corporate bonds works. Corporate bond is an investment instrument strategy used for businesses when they need to raise money for growth and expansion. A bond is a security issued by a company to an investor. The company basically will repay this investment with a fixed interest rate over a pre-planned period. Okay, now I will talk about how corporate bond work. Basically, a company decides they want to expand but need financing for the necessary resources. They will begin to establish themselves with investment corporation, since this is where investors view the different bonds available along the company details and recorded like company profile. If bonds are chosen, the par value is paid by the investor. What is the par value? Par value is listed price of the bond. The issuers will pay the face value with an interest rate to the investors. These payments are compounded and annually or semi-annually towards the maturation dates. And what is the relation between maturation dates and the face value? Maturation date is the date which the principal will be fully repaid. I think that's all for the introduction. My friends will continue how the corporate bonds works in Malaysia. Thank you.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Wanur Izzah Nabila and I will explain about the characteristic of the corporate bond. Credit rating agencies such as RAM and MARC. Second is risk. It has three risks, which is credit risk, market risk, and interest rate risk. For the credit risk, it is the risk that the bond issuer is unable to pay the coupon payment on the dates that has been set or at the maturity. Second is market risk. It is the risk of price fluctuation and its effect by the demand and supply of the bond in the market. Third is interest rate risk. It is the risk of price fluctuation due to changes in interest rate and it will cause price of bond decrease. The third is bond features. The investor need to identify if their bond have the additional features of a call provision or a convertibility features, and it called as a two bond, which is callable bond and convertible bond. Next is tax status. There is a tax exemption on interest earned by individuals investing in bond in Malaysia. Next characteristic is yield to maturity. The current coupon income and any capital gain or loss takes into account that the investor will get by holding the bond to maturity. Next is trustee, a financial organization that has been given fiduciary powers. It is to ensure the obligation of the bond contract is met between the bond issuer and the bondholder. They act in the interest of the bondholder. And lastly is the warranty. The government, commercial or holding company will act as a guarantor for the bond issuer in case of a default.
Hi, my name is Hanuza Omar and I will share with you the general overview of Sukuk in Malaysia and a bit on the challenges and prospects. Sukuk, from Islamic finance perspective, are certificates of investment which will entitle the holder to a proportionate share of ownership in the underlying asset of the Sukuk and ownership in a business venture, along with the profit and loss of the associated with the business, assets or investment activity. There are many challenges to Sukuk in Malaysia. These include the need for continuous and authentic product innovation to attract the investors. Other challenges include the issues related with the underlying asset used in the Sukuk project, lack of liquidity in the secondary market. This can be a significant feature of Sukuk, depending on which type of contract being used. Different interpretation, different legal framework for sukuk, and many more challenges are some of the things that the investors and issuers face during sukuk in Malaysia. The growth of global sukuk market has been characterized by key players such as Malaysia, the United Arab Emirates UAE, and Saudi Arabia, as well as the emerging market such as Turkey and Indonesia. The percentage shares held by global sukuk by country in 2016 and 2017 showed that Malaysia is still the global sukuk market leader. As for prospect for sukuk in Malaysia, being the world's first sukuk in 1990, with Shell MDS issued $125 million sukuk, and since then, the market has been growing strongly. Malaysia's sukuk issuances has increased to almost 200 billion in 2018. In the first quarter of 2019, Malaysia was the top sukuk issuer with 35% of global share, followed by Indonesia in second with 17% and Saudi Arabia with 15.3%. Sukuk has been identified as a leader consistently in the overall Malaysian bond market, accounting for 60%. Sukuk's unique characteristics such as an Islamic fund that is safe, not involved in excessive speculation, and having generally low trading turnover makes sukuk less volatile than conventional bonds. Other market conventional instruments such as Singapore, United Kingdom, South Africa, Luxembourg and Hong Kong have now seen the potential in sukuk. Launching of the Sustainable and Responsible Investment SRI by the Securities Commission in 2014 have been an important milestone in sukuk growth. The SRI sukuk framework is in line with the initiative Capital Market Master Plan 2. Malaysia is addressing the relevant issue and growing concerns over environmental and social impact of business and greater demand for stronger governance and ethics. Hence, the launching of the Sustainable and Responsible Investment. It is very advantageous and effective to tap into these opportunities as the Malaysian capital market is well positioned to capitalize on these changing trends and facilitate sustainable and responsible investing. Besides launching the world's first sukuk in 1990, as well as the original global corporate sukuk in 2001, the issuance of the green sukuk in July 2017 represent Malaysia's leadership in the global sukuk market in the innovation category. In conclusion, Malaysian sukuk market has benefited from robust demand and tax incentive granted by the Malaysian government to both issuers and investors. Sukuk market also offers effective portfolio diversification opportunities for fixed income investors. It has a great potential alongside with the conventional bond. Thank you.
Okay, today I will discuss about the challenges of the Malaysian bond market. Basically, we know that after the Asian financial crisis, the bond market has growth tremendously. But there are still two main or major challenges to the bond market, which is the pricing challenges, and the second one is the liquidity challenges. On the pricing challenges, there are two major issues, which is the corporate bond will be issued, and they use the MGS or Malaysian government security as the benchmark. They can't really spread the price too high, whereby it will scare off the investor. And then the other one is the volatility of the market with the expectation of increase in interest rate. We know that interest rate can change overnight, so this will have quite a big impact on the secondary bond market. It will affect the demand. Okay, let's look at the second bond market challenges, which is the liquidity challenges. The two main liquidity challenges, number one is the over reliance on the domestic investment. This is true in prior year to 2000, or more specific in 1997. After 1997 and 2008 financial crisis, the government has established better framework whereby it has widened the investor base. More private sector has been involved in the bond market. This is especially true when the government or the authority established the CMP1 and CMP2. CMP1 from year 2000 to 2010, whereby CMP2 is 2011 to 2020. And then the second one is the lack of secondary market liquidity in corporate bond, leading to investor preference to hold the bond until maturity. In these issues, the government also has played their part, whereby they establish better payment system like rentas, and then they establish the electronic trading platform ETP. This establishment has in fact attract more investor to be involved in the bond market.
The first strategy for stabilization of the Malaysian bond market was done through the improvements of issuance procedure. So prior to July 2000, the merit-based regulations (MBR) on bond issuance process took an average of 9 to 12 months to be approved, which was very discouraging due to the uncertainty long period of issuance procedure. So SC has developed a new disclosure-based regulatory (DBR) framework and came up with a revised guideline on the offering of private debt securities. And this new PDS guideline allows corporate issuer to secure approval within 14 days after submission of complete documentation. This improved efficiency on the issuance process has encouraged sector to raise financing from the bond market. The second strategy evolves around the initiatives in promoting secondary market liquidity. In October 1997, the Bond Information and Dissemination System (BIDS) was introduced with primary objectives to enhance transparency of the bond information, facilitate trading, and increase liquidity in the OTC debt securities market. So BNM announced further development initiatives aimed at improving market liquidity, accessibility, and also efficiency in the secondary debt market. In the year 2000, non-financial institutions are allowed to enter into repurchase transactions, making the increased ability of bonds to be borrowed via repo for market-making activities. In the year 2001, the Securities Borrowing and Lending Program is introduced via the Renta system, a computerized scriptless trading system to facilitate faster and more efficient trading, registration, and settlement of securities. So in the year 2004, Institutional Securities Custodian Program, or ISCAP, was put in place to encourage institutional investors to lend securities to BNM. And a securities lending facility for principal dealers were introduced to facilitate market-making activities and promote competitive pricing. And principal dealers were able to enhance their ability to provide and quote continuous prices for Malaysian government securities and improve further the price discovery process, thus promote liquidity in the secondary market.